This week on By the Numbers, join us as we take a look at Starbucks as a bellwether for the overall economy, our job cuts accelerating a recession, and the Biden administration's proposed barriers on China to protect its manufacturing agenda. So sit back, relax, grab a cup of coffee, and join us as we take you through the numbers. Hi, Lauren.
Hi, Lyndsay.
How are you?
I'm doing great. How about you?
I'm good. Happy Mother's Day.
Happy Mother's Day to you as well.
Thank you. Did you have a good weekend?
I did. Mine's still very young. So I got a couple of decapitated dandelions, and it was just the greatest bouquet ever.
Oh my gosh. I saw that on your social media. That's so cute.
It was fun. But yours are a little bit older. Did they do anything good for you?
Yes, I still get the dandelions.
Oh, I'm glad that doesn't end.
No, it doesn't. My daughter usually picks ones that survive a little bit longer, not dandelions, other yard flowers.
Okay, but perfect.
Yeah, I always entertain them and put a little vase together on the windowsill.
Oh, I love it.
Yeah, we had a packed weekend. It was my daughter's birthday party and then Mother's Day on Sunday. So yeah, it was a jam-packed weekend, but full of fun.
Oh, fantastic.
Yeah, so definitely needed my coffee run this morning.
Yes.
Made it to Starbucks on my way in, ordered on my mobile app. My name is spelt right on the cup. You know, the mobile order experience is so much fun.
Yeah.
And I'm not just talking about Starbucks for no reason this morning. We are not sponsored by the coffee giant.
We wish.
Our first article today is about Starbucks.
Yes. So maybe we're not getting that sponsorship after we talk about this article.
Yeah, maybe not. But let's jump into the headlines.
Let's jump into it.
Okay, so first headline of the day, Starbucks sales are slumping. Is it a bellwether for the economy? The company's shares have plummeted about 17% in value since last week. Starbucks' former CEO posted on LinkedIn, the brand is incredibly resilient, but it's clearly not business as usual. So reading the headline, reading the subheadline, headline talks about sales being down, subheadline talks about shares. My first question was, what causes shares to plummet? Is it just sentiment? Is it perception? Or are shareholders actually looking at revenue figures? And what story does that tell?
Right. Well, there are a lot of things that go into stock prices. But what this article is trying to say is they're trying to make that connection between Starbucks share prices and somehow the overall U.S. consumer. And so as we're going to talk about, I think that's reading a bit too much into the story because you're right. The first question isn't just are Starbucks share prices down because our consumer is going into a recessionary mindset, or maybe is something going on at the company. Now, again, there is a lot that can alter asset prices from the company, right? What do we think of their leadership? What are their revenues doing? Are they making big investments? Are they pushing into some new growth sector? Or just how are interest rates doing? Are stock prices overall up or down? So a lot of different things that we can start to unpack between what's behind this actual decline in price.
Yeah, so the article in summary is talking about how I think it actually says many analysts use Starbucks as a benchmark for the economy and talking about, you know, if sales are down at Starbucks, does that mean that the economy is going into a recession? Now, that seems a little bit silly, but I know from my past life, when I was a business consultant working in the flooring industry, when we were looking at opening new locations or taking on an existing location, one of the things that the sales team, the boots on the ground, would do is look at the proximity to a Starbucks. So there has to be something to that. I guess my question is ITR in the camp of analysts that use Starbucks as a bellwether?
Well, I don't know if your location scouts just really needed their coffee.
That's probably
maybe
true.
That's why you were in proximity, but it's true. There are a lot of different measures we can look at to, you know, what is the consumer doing? Now, Starbucks specifically, I'm not sure they're the one and only. As you know, we here at ITR, we believe in a system of leading indicators, even if one is really, really good. So one company, and we could look to Starbucks, we could look to FedEx, right, for if we're ordering things online and shipping them a lot. We could look to a number of different consumer brands to say, here's what we think, right? Here's a good bellwether for our economy. So I never want to hang my hat on just one, but we do find that Starbucks, well, if you'll allow me a chart so we can
Always a
start to put
chart.
some numbers to it.
Yes.
The first question I want to get to is it Starbucks share price we should be looking at or something like Starbucks revenue? Because while share prices are down, revenue in the first quarter, it was actually roughly flat on a 3/12 basis in North America specifically.
Okay.
If we look globally, slightly different numbers, revenue rising on to a greater degree here in the US and in North America than it is globally. So a lot of those share price considerations, they take into account the global picture a little bit more. But again, if we just look at Starbucks stock price, saying that is our correlation here, sentiment is telling us what the consumer believes, there's something going on. So some correlation, we find about a 0.53 is the correlation between stock price, which is the green line, and overall retail sales.
And is that a good correlation or subpar correlation? How do you calculate that?
I mean, I'll put it back to you. What do you think of these two lines? There's something happening here. We do see some amount of rise, but then there are a couple of missed cycles where one thing happens in the stock price that isn't reflected in our overall consumer measure. So right now, we're kind of at that very tail end. I have a 5-month lead time. So what this article is saying is that this rate of change decline in the green line, that stock price line, is foreshadowing decline in deflated retail sales.
Okay.
I don't think that's so far off base. We are starting to see the consumer pull back a little bit, tighten their belt. However, if I, again, broaden our stance, don't look at just Starbucks, but take an overall consumer discretionary ETF, so many more stock prices for many more companies, we find a 0.78 correlation to just one sample ETF.
The article, since we mentioned the pandemics, the worst since the pandemic, I'll stay on that topic. So the article stated that people flocked to the app with stimulus money. The article gives Starbucks credit for accommodating a global challenge with a solution. And the quote exactly is, Starbucks could charge a premium because it's a little bit special. Now they're charging $6.50 for people to walk in and walk out 10 seconds later. So, as a frequent Starbucks goer, as I mentioned this morning, I really haven't seen a change in my particular relationship with Starbucks. And I read that $6.50 to walk in and walk out 10 seconds later. Isn't that what fast food is about? You're supposed to be able to either walk in, walk out, or drive through, drive out with a coffee in 10 seconds or less. That would be nice. But if you've ever seen a Starbucks line, that is not the case.
That's true.
Hence the mobile app. But the stimulus money, flocking to the Starbucks app, I think is a little bit dramatic. And I don't know that it's necessarily fair to say that Starbucks came up with the solution because I was using the app far before the pandemic. And if anything, I wasn't driving to the office. So I wasn't driving by Starbucks and picking up my daily Starbucks. So I think that my spend perhaps even went down with Starbucks. But talk to me about the post-pandemic. I mean, you just said that it was at a record low point.
Yes.
But we talk about stimulus money.
Right. And
everywhere.
That's the question, right?
Yeah.
Are we still feeling the echoes of that stimulus spending? Because Starbucks is and was really one of the first special experiences. It wasn't just you're making your drip coffee at home in your kitchen. You go in, you can sit down, the barista calls out your name, and Starbucks was really the first mover in that space. They talked about creating this kind of third space. It wasn't home, it wasn't the office, but it was this community space.
Right.
Now, that story's largely played out, right? We all know there's a Starbucks, but there's also my other local coffee shop. There's, a number. I mean, I can sit in a Panera and work. I can sit in a number of different kind of environments like that. And so once we layer in the pandemic where we couldn't go sit in places in person, you did just have to pick up your coffee and go. That changed consumer buying habits. And the stimulus money, that is the big one that, again, we're still feeling these echoes of people just having a little bit more money in their pocket, a little more spending money. I'm going to get myself a treat. Maybe it isn't even my morning coffee. It's a refresher or it's a cake pop for the kids or whatever it is. So it is still special. It's an affordable little luxury. But when we're now talking about inflation being so high and consumers starting to worry about their finances, maybe tightening the belt, trading down in brand, maybe I don't need that little splurge every day. I'm going to be smarter about budgeting. So there are a few different factors at play, especially when we talk about Starbucks.
Yeah, so we've talked a lot about like the strength of the consumer. And this article is referencing credit card debt. They're talking about stubborn inflation and an increase in credit card debt plus the excessive borrowing costs.
Yes.
So calling out the credit card debt in particular, is that something that is perhaps a bellwether in and of itself to a softening consumer strength?
Lyndsay, you know this is my pet peeve when these articles call out as they said a spike in credit card debt, but I've heard this called a record high credit card debt elsewhere. It's such a catchy headline. It's so buzzy. So if we just look to the numbers, yes, in 2023, total credit card debt was at a record high. It reached $1.1 trillion. But again, we have more consumers in this country with more credit card accounts. We have generally higher prices. So as we look at credit card debt, as we've done here in the past, as a share of median annual earnings, it's only 14.4% compared to our 2019 level was 15.3%.
Okay.
And back in 2007, 2008, this was over 20%. So we are taking on debt. Yes, that is a problem. Yes, for some individuals, for some even pockets, right, of concern. But for our overall consumer, for the average American, I wouldn't be worried about this record high credit card debt.
Right. Maybe people are just being smarter about how they use credit, because credit isn't necessarily a bad thing. We all know, especially referencing those excessive borrowing costs, if we're out there needing to build our credit to buy a home or, qualify for the best mortgage rate that you possibly can, especially during this time, you need to have good, solid credit. And the way to get that is with credit card debt to an extent. So maybe the consumer isn't softening, they're smartening.
Well, we hope they're not rolling over credit card debt. Typically, credit cards have a much higher percentage rate that you're paying in interest. I mean, those will be above 20%, no problem. So we don't want to see people borrowing on their credit card because typically that's not the healthiest decision they could be making. Now, in certain cases, you need to. In certain cases, right, for an individual decision. I'm not trying to judge there, but we don't want to see that month-to-month rollover. It's better if you're trying to build credit to say, put money on your credit card, yes, but pay it off in full every month. Do your borrowing in a more targeted, intentional way.
But let's take it to something a little bit more fun. I mean, like I had started at the beginning of this, looking at Starbucks as a bellwether for the economy. Besides the fact that the article literally said many analysts look at it, which I was like, is that true? That it seems kind of silly.
Yes.
So are there other silly indicators that folks in your chair are looking at? Maybe they are, maybe you're not falling victim to false signals from them, but are they these little like wives' tales or funny things that you guys look at?
It's funny because analysts will look to anything to get an edge. And so there are a lot. I've pulled together other indicators of how good is the economy doing. Okay. And some of these come from very respected economists and very notable public figures.
That makes it so much more fun.
Oh, it makes it great. My favorite one came from actually Alan Greenspan has a measure. He said when men's underwear sales stagnate, that means the economy is going downhill because men especially, they'll wait longer to buy worn out staples. And if you can't see it, like underwear, they'll wait longer. So I guess look to Holy underwear as an indication that the economy is going down.
To your research project.
Okay.
That has to spike around the fourth quarter of every year.
When the wives go out.
Yes, right? Is that not what we all gift our husbands or partners or
socks and underwear sales? So we'll have to normalize out, right, the seasonal trend.
Yes, so that's why we look at things on a 3/12 and a 12/12 basis.
Exactly.
All right.
Take out those normal Christmas underwear stocking stuffers.
Yes.
But I've got some other ones. I love this one. Skirt length. The higher the hemline, the higher stock prices will be.
Oh,
and I guess the reasoning here, I couldn't find one, but what they say is that short skirts mean that we're all happy-go-lucky, right? Things are great and we feel good, so we're out there spending money. So short skirts are good for stock prices. I had actually heard of this one before. the ping pong table index. So this one specifically relates to the tech sector. They
Okay.
said someone went out, some tech investor, and surveyed ping pong table dealers, if such a thing exists, in California. They said whenever, that's the kind of hallmark, right, of your tech startup, they have a ping pong table in their break room. And
Yes. Okay.
so when they're selling more ping pong tables, I guess there are more tech startups.
Okay. Well, that makes sense. I think one thing I've learned is that there is a survey for everything.
Isn't it amazing?
Especially in my job, you would be shocked how many times clients will come to me and say, "We have this survey data. Can we forecast based on the survey data?"
Really?
Yes, it happens all the time.
Well, I guess it depends what they're surveying.
I mean, ping pong tables has not
a
been
good
an
one.
ask yet, but I will. I'll let
Well,
you
I have
know.
one for you today, Lyndsay.
Okay.
Lipstick sales.
Okay.
The theory here, and I believe this one actually came from the CEO of the Estee Lauder company, when people buy more lipstick when they can't afford the more expensive beauty products, but that lipstick stays, the kind of affordable little luxury that you
Yeah.
can still get your lipstick.
I think that answers that question that was probably in like Cosmopolitan back when I was a teenager. That was like, if you were on a deserted island, what like 2 or 3 beauty products would you take with you?
Apparently lipstick. It's unclear, by the way, if the pandemic broke this one when we all had masks on. You didn't
Oh,
need lipstick. So I
yes.
don't know if this indicator is still reliable. But my last one, this was my absolute favorite. In years that an AFC team wins the Super Bowl,
Okay.
it's supposed to be bad for the economy. No reasoning that I can find out. Although I personally was suspicious that my beloved Patriots were very dominant in years leading up to the Great Recession. So perhaps, and they are an AFC team.
Okay.
But this one actually has almost a 75% success rate at predicting the stock market for that year.
So if an AFC team wins
Wins the
the
Super Bowl.
it's bad for the economy.
It's bad for the economy.
I think you and I could have taken that and actually done an appearance on the Tom Brady roast on Netflix.
Goodness.
If you haven't,
It's his fault.
it's
That's right.
his fault. If you haven't seen that, it's hysterical. It's hysterical.
So a little bit of bad news. Kansas City, that is an AFC team, the most
Okay.
recent Super Bowl victor. So watch out.
Okay, so it sounds like we can't rely on Starbucks to help us to determine if there's more caffeine jolts coming to the economy, or perhaps we're drinking decaf.
Oh,
but
that's not good.
No, never good. But you just gave us a whole list of other indicators that we really can't use either.
Nope.
But that's all the time that we have for today here on our free segment on YouTube. Remember to like and subscribe so that you can keep watching. Or if you'd like to view the whole episode where we talk about other indicators that are perhaps a better representation of what's coming in the economy, remember to click the link in the description below and subscribe on our website. Bye, Lauren.
Bye, Lyndsay.